Hi everyone. In case if you have ever applied for a business loan or approached a bank, you must have heard the term DSCR thrown around quite often. So in this video, let's understand what is DSCR, what it stands for, and also let's check how can we use it for getting our chances higher for getting more credits from the lender. So in this video, let's understand what DSCR is, what it stands for, why do banks and NBFCs love this number, and also how can you use this term to make your chances to get a credit better. So DSCR stands for debt service coverage ratio, so which is basically says that how risky is your business. If we go by the formula is that net operating income divided by total debt obligations gives you DSCR, the debt service coverage ratio. So now let's break it further. So net operating income is the total income earned by the business during the entire year before interest and taxes. And if we talk about the denominator, which is total debt obligation, it is the entire payments which we need to make repay of, which is combination of principal plus the interest. So let's understand it from an example. For example, if your business is earning 10 lakhs from the business, and then total debt obligation which you need to pay off is 8 lakhs. In that scenario, the DSCR is 1.25, which is on a safer side. So let's understand what is this 1.25 means for the business. So it means that for every 1 rupee you have to pay or you have to repay, you are earning 1.25 rupees from the business, which is on a safer side. So which means that in case if your DSCR is above 1, it is positive sign. If it is equal to 1, which means you are just breaking even. And if it is below 1, it's a red flag. So banks and NBFCs use this term to check how risky your business is, how you can repay off your debts. So in case you are in a very high risk business, in that scenario, the DSCR which they prefer is 1.5 or even above. In case it's lower than 1.5 or more than 1, in that scenario, they will need some collateral or a guarantor to go for giving you up your loan. For usual SMEs, it is 1.2, which is on a safer side, which means that the business is healthy if it is 1.2 or above. If it is less than that, the lender will not be okay to go ahead to lend you any amount. So now the question is, how can you use it to increase the chances to get credit? So it is that in case if you are actually applying for a loan or going to take a loan in the near future, what you need to do is that cut down your cost so that the revenues go up. So while the revenues go up, your net operating incomes will go up, and that's where the DSCR will build up, and it will be higher than whatever the current DSCR is. You can try to apply for loan whenever your cash flow is the strongest, which means that if you are in a seasonal business, then definitely you should go ahead to a bank as when your cash flow is strong, and that's the chances that your DSCR will be stronger, and there is a more likeliness the NBFC or the bank will lend you. Another way out is that you have to show a good projection. So bankers love good projections. If your business is promising, definitely you can show them that how your DSCR ratio will grow over time, and that's when they will be more willing to lend you. So DSCR, debt service coverage ratio, is a simple term, but it is like a financial fitness score for a business. So definitely next time if you go up to a lender, try to check your DSCR or even try to see avenues how you can build this DSCR better, and then go to a bank. That will improve the chances for you to get credit. So similar to like this kind of concepts, do follow Direct Credit, like, share and subscribe on all the social media platforms where we are. That will definitely help you to understand more financial terms, and it will help you to grow your business multifold. Thank you.